We are going to talk about Oracle, ticker symbol ORCL. Year to date, this company's up 30.92%. Of course, 1 year, 42% up. Oracle just reported their earnings yesterday. Top line missed by 17 million. Their bottom line beat by 4 cents. So we're over here at their earnings release, their 8K. They noted that Oracle's RDMA interconnected NVIDIA supercluster clusters train AI models at twice the speed and less than half the cost of other clouds. Um, I put a little note in there that to me potentially sounds moat-worthy. Might be something to look into to maybe understand a little better of what that truly means. Because to me, I'm not well versed in that whole field, but that seems like that could be something very positive for the company. Anyway, down here at the revenues, we had 13% revenue growth in our cloud service, which is 77% of our overall revs. And we had a decline in cloud license and hardware of 10 and 6%, and a 2% growth in services, which is 11% of our revenues, for a total revenue growth of 9%. Cloud services and license support increased 26%, which is about 18% of our total revenues of our cloud there. Well, actually, of our total revenue, really. And services is 15% up, and basically 10% soaks up almost all of our revenue there. So they don't really make anything on services. Sales and marketing down a little bit. Research and development is up a little bit. Both very lot of money flowing into both sales and marketing and research and development of a total of $4.2 billion. General administrative actually down a little bit. That's good. Amortization of intangible assets. So they're putting this on the income statement, and it reduces taxable income. Restructuring, they may be upgrading some of their cloud services or technology of some sort. So, or they could be, since their general administrative is down a little bit, it could have something to do with reducing headcount over there as well. Overall operating income came in year over year up 26% and is also 26% of our overall revs. Net income increased 56% year over year, and also they brought 19% down. Share count went from 2.7 billion up to 2.8 billion, so they added about 60, 70, 80-ish, just shy of 80 billion, 76 billion in shares, or million in shares. So down here they have more future tax write-offs for their intangibles. So they're going to do this throughout the course of each year, but next year, or sorry, actually remainder of this year, they're going to do another write-off of $2.2 billion on that intangibles side of things up here, right here. So over the course of the rest of the next 3 quarters, they got another $2.2 billion to write off on that side of things. So cash and cash equivalents, they increased their cash by $2 billion. This is over the course of 3 months as well. So a little question mark as to why so much so quick. Could be fine, but let's just find out why. So we'll keep that in the back of our mind once we get to the cash flows. Overall total current assets, they went up 1.1 billion. Intangible assets we saw is down now 763 million. Goodwill, they have a lot of goodwill. Personally, I'm not a big fan of goodwill. I know that, I would assume their goodwill is a lot to do with their cloud data that they've got. So they're probably got a price tag of that. That's fair, honestly, but I just I don't know. I just don't like that at all. Obviously, it's hard to put a price tag on that, I think, because tomorrow that could all get wiped out for some reason. So, total assets, 136 billion in total assets, 2.3 billion increase. Basically, you can just say it's an total increase just from your cash. Everything else was nominal. Deferred revs, they ticked up about 2 billion. This will show up on their cash flows as a positive, so it's a negative on their liabilities because they added liabilities, but it was a positive on their cash flows. So overall, $2.3 billion increase in their current liabilities, and then their total non-current liabilities ticked down a little bit for a total liability amount of like 33 billion, 34 billion almost. They had an equity increase, stockholder equity. Net income, they brought their $2.4 billion down to their cash flows. They have their amortization of intangibles that we saw, which comes over here as a positive because they reduced it off of their assets. Stock-based comp still got a lot of stock-based comp flowing in this company, 850 million. Increased deferred revs we saw 2.3 billion, gives them a total net cash provided by operating activities of 7 billion. Subtract out 1.3 billion for capex, gives us a free cash flow of $5.66 billion or $22.6 billion annualized. That is fantastic. Very nice numbers. Payments, repurchase of common stock, one, they bought back 150 million and they gave back out 308 billion or million. I just saw this yet last. They issued $20 billion of senior notes. I'm assuming it's got something to do with their acquisitions up here. They bought Centrex, I think, something like that. So they finalized that deal earlier this year. So I'm assuming that has a lot to do with that. Total gain share issuance is 1 billion of the 1.8 billion dollars. So 1 billion of this 1.8 billion was from shares that they issued. So really they only made 848 million dollars of actually using their business. So nobody's a real big fan of getting diluted when you own this company. But $1.8 billion gets added to their $9.7 billion, which gives them $11.6 billion cash and cash equivalents, which is where that $2 billion roughly came from. So now we know that over half of that was just from stock-based comp. Over here to the valuations. Statistics on the company. We have a market cap of $279 billion. Dividend yield of 1.46%. Return on equity. That's probably like that because of their purchase of their most recent acquisition. Return on invested capital, 11.4%. We really would like to see 15 or more, but I mean, still, it's positive. Gross margin, 72%. Operating margin, 27%. Profit margin, 18%. Analysts have a price target on this company of $126 per share and revenue growth of 10%. Their EPS growth forecast, not sure why that's not showing up, but down here we can see it. They have 86%, 12.5, 13.6. Peter Lynch valuation, 13.6% return on invested capital today. We have 3-year forward earnings per share of 37%. We have revenue growth of 9%. Peter Lynch fair value of $120 per share. Multiples comparison, we have $256 is what our price tag is compared to our competitors. Market cap, 2.97 billion. Cash equivalents, 12. Debt, 133. Cash from operations, 28. Gives us our multiple of 15 years. So it'd take about 15 years to earn our market cap, which puts us at an undervalued price. Price to book was invalid, so there's nothing there to see. Peg ratio, 3.84 currently, really overvalued, but forward looking, seems very fairly valued. Over here, Graham's valuation, I'm going to give them a 0.5 because they're currently above 20% on EPS growth, but only for this year. Going forward, looks like they're below 20%. So going forward, it'd probably be more of a 1.5 maybe, but we'll give them a 0.5. And right now, the intrinsic value on that would be $74 per share. Our discounted cash flow, 6.43%. Perpetual growth rate, 2.5. Our free cash flow growth rate of 20%. Analysts have 40%. And we've had an average growth rate of 1.6. So I just cut it in half and said, here, let's give it 20%. Cash from operations, we went from like 15 to 17 billion. However, our capital expenditures went from 1.7 to 8.7 billion dollars. So going the wrong way in terms of free cash flow. However, forecasted, forward looking anyway, it looks like we're going to do about $22 billion potentially of free cash flow. I mean, this quarter they already did $6 billion, which is almost what they did last year, which is more than what they did in 2022 in one quarter. So, I think it's fair to say 20%. I mean, really, 40% might even be true as well. But regardless, the numbers are the numbers. So we're going to do 20%. Gives us a DCF price of $135 per share. Our lowest earnings per share growth rate was 9. So 9 goes into 72, 8 times. 8 goes into 10 years, 1.25 times. we're going to take 1.25, we're going to double our earnings per share one time, and then 0.25 times, which gives us a future earnings per share of 8.65. So that gives us a fair value today of $38 per share, or a purchase price of $27 per share with a 30% margin of safety. Over here on our summary, we can see our average price is $125 per share. Our purchase price is $87.40 per share, which would be our 30% margin of safety. Which, if we look at the analysts are predicting $125.85. So we are in line with analysts. Good on this what I saw overall was, if free cash flow keeps up this pace for the rest of 24, they're gonna have $22 billion in free cash flow, which is really, really good. They made and when you get $22 billion of free cash flow in one year, I mean, that's a lot of money to spend to reinvest in dividends or share buybacks, a bunch of things, improve the business, grow the business. They made a bold statement in their 8K saying their RMDA supercluster trains AAM models twice as the speed and less than half the cost of other clouds of their competitors. The free cash flow doesn't cover their net income. Free cash flow has been flat and most recently declining, although that appears to be turning around. Overall earnings are telling me growth is slowing. It is appearing that it's slowing probably because of the next line here, that there's lots of high dollar competitors in the cloud space that they're soaking up so much of the market share. Because Oracle only has about 2%. It's not 2.5, 2 to 5. It's about 2% of market share. Amazon, I think, is the leader, and they're at like 34% of the market share. And then Google and then Microsoft are the top three. And I think Oracle is number 5 or something like that on the list. So, they can grow, but they've just got a lot of high dollar competitors ahead of them to grow. I mean, they can definitely take some of that market share from them, but unless this unless this makes them more money because they can train AI models at twice the speed and half the cost at other clouds. I mean, that seems very bullish, honestly. It sounds like it. I mean, that's something to look into and maybe understand a little bit more than what that sentence just says, but maybe Amazon and Google and Microsoft are too far behind that. I don't know, but something maybe to look into. But overall, we got our price tag $125 per share, our purchase price of $87 per share. Let's see what the stock chart is telling us. So currently, we are trading at $109 per share, and we had our earnings, so we went from 127 all the way down to 109. So we had a big red day yesterday. Really, there's nothing here to say. There's really just no channels, no, I mean, it's just kind of there's not much to draw, in terms of support and resistance. I mean, down here is definitely, I would consider a support range, 65-ish dollars. And then right here is maybe a support range at $94. Kind of hard to tell. Honestly, there's not really a lot of data here to tell you where support and resistance are. But, we know that 87-ish dollars per share is our 30% margin of safety. So we could maybe look to purchase this company if we're interested at about $87 a share. Based on valuations, that's what it's telling us. The future free cash flow looks juicy on this company, which gives them a lot of extra capital to invest into their business and grow the business and buy back shares. I'm wondering if the recent pullback wasn't because obviously the earnings miss probably has something to do with it, or maybe analysts had higher expectations than what the company actually produced. So it could be also forward guidance as well that said that made investors run away from this company. But overall, Oracle looking, hopefully it pulls back to like that $87 range, and maybe it could be a good place to start a position. But that's it for Oracle. If you found value in this video, drop a like, subscribe, and we'll be back later with another stock analysis video.